Good afternoon, Chair Eggman, Chair Dababneh, and honorable members of the local government and banking finance committees, as it would be. My name is Michael Lemire. I'm a Senior Vice President at Y Green Energy Fund, one of the original employees. In fact, I've been working with Y Green in the PACE industry for over 6 years. And Y Green's a leading provider of PACE financing in California and across the country. We currently partner directly with JPA cities and counties. We serve over 230 local government partners in California. And we provide a full service, similar to my peers here in their firms, operation for local government that includes, among other things, robust consumer protections, contractor oversight and management, underwriting, customer service, capital markets expertise, as well as other related services. Y Green is very proud. I'm very proud of the association, not only with my colleagues and partners, but the reputation and the strength and quality of individuals and firms in the legal community and the financial community and other stakeholders that are involved with not only with our program and our company, as well as the industry. Out of respect to the committee and the request of information, we did submit the required, and I have incorporated into that my remarks. But and I'm prepared to answer any questions along those lines. However, I did want to kind of shade my commentary, not to repeat what my peers here said, which I echo in terms of the benefits and impact and positive nature of PACE in California. Some of the issues raised in commentary today around whether there's lack of regulation in PACE, inadequate consumer protections, potential harm to lenders of GSEs, and I'm sure we'll hear anecdotal evidence or items later today, but we'll present facts and data, which I believe I've heard from a number of quarters are eagerly needed or required or desired upon this committee as well as others in the community. One distinction I will make, or broader kind of commentary I want to make sure is reflected on the record, is that while the umbrella of PACE and PACE programs and all the different private providers and local government and stakeholders, the vast majority of how these programs operate, at least with full service administrators such as the three represented here, are identical or extremely similar. There are some structural changes, and when we're considering regulation, policy, or the legislative activities, to consider and keep in mind the two statutory frameworks, and Y Green does represent, both through our government partners and ourselves, a model that is constructed under SB 555, which is an amendment of the Melrose Act. You've heard one public provider incorporates that as well. We're the only private administrator there. It's not to say one program's better or worse than the other, but there are some advantages and disadvantages. And I think what it really does in the bottom line is round out the amount of options and possibilities for property owners and stakeholders in the program. The overall structure of our program and our government partners includes all three cities, counties, and joint power authorities. Currently, we are actively managing programs for 2 joint power authorities and 1 county in the state of California. Our primary government partner is Golden State Finance Authority, an element of RCRC, the Rural County Representatives of California. I think it's particularly germane to mention Golden State because I think they're unique in their involvement in the PACE industry. Golden State Finance Authority has been around for over 30 years and specifically operated programs that have assisted first-time and low-income home buyers purchase a home and obtain a mortgage. They've been involved in originating over $30 billion in real estate transactions in California and also nationally. And their staff, as public employees of the JPA, have deep expertise in underwriting, issuance, audit, oversight, and other features of the program and the market. Y Green brings to the table, so to speak, multiple capital providers to financial structure. In addition to our local government expertise and experience on our team and our energy expertise, we're particularly deep in capital markets and underwriting financial service background. So that is one of the unique attributes we think we bring to the market. We also, similar to other programs, have robust not only consumer protection, but specific to Chair Dababneh's comments, contractor oversight program. Now, I think it's important at this point, though, to recognize that all of us here and many others in the room and around the state of California have been building creating a product, a company, or companies, and an industry from scratch over the last 8 or so years. And you're never going to be perfect. Every outcome is never going to be perfect. It's what you put in place up front, and then how you deal with the exceptions, the rare exceptions, of which unfortunately we did hear from the people that you noted. And our process, I'll speak for our program, has a very low consumer complaint and also contractor complaint rate. However, when those situations arise, we have a well-defined process that's known up front, that's articulated in a code of conduct that is required by the contractor to abide by, and results in numerous actions, up to and including expulsion from the program. So these protections at the contractor level, irrespective of other elements of the program, are in place. They've evolved. I've seen them evolve personally and strengthen. I'm absolutely confident that they will continue to do so in the industry, led by not only us, but our peers and colleagues in the industry, and welcome additional ideas and thoughts to that effect.
Okay.
To the point of data, which I believe has been absent a lot of the commentary over especially over the last several months, and specifically to address some of the FHFA issues that were requested ahead of this committee hearing. I'll offer some of these numbers. 100%. That's the number of property owners who voluntarily agree to or select PACE financing. It's a 100% voluntary on part of the property owner. 100% is the number of property owners who receive full and fair disclosures. In fact, even though you've heard about them strengthening, clarifying, they have been consumer disclosures, including but not limited to the FHFA concerns, have been in place in all the programs I'm aware of, including ours, from day one. 100% of lenders that on mortgages and participating programs within Y-Green and GSFA's program receive notification prior to lien and financing agreements in place. We have funded over 15,000 projects and have 0 tax payment defaults in the program. And also, we've analyzed on a regular basis, we analyze the subsequent mortgage foreclosure rate of projects that were approved in our program, and to date that rate is 0.02, not 0.2 or 2.0, 0.02. We've heard similar statistics from other providers, and we feel that this is evidence of very strong underwriting, disclosure, and management processes in the program. Also germane, and not to kind of overdo the data, but we have a customer prepayment rate of approximately 4%. So a very small percentage, for whatever reason, whether it's because they had to prepay the PACE lien for the buyer to obtain a mortgage or refinance, or because they were able to refinance at a lower rate than the PACE payment. Less than or approximately 4% of our customers have prepaid. We feel that these facts support a very strong program, very strong outcomes, and very positive results for our property owners and for all stakeholders in the PACE industry. Thank you.
Thank you very much. Other questions from Mr. Dababneh?
So, Mr. Lemire, I apologize for not recognizing your name first time.
Mr. Lemire, thank you.
Lemire. As someone that has a very hard to pronounce last name, I appreciate that. Mr. Lemire, I will say that I do appreciate you reaching out. The Masons who were at the last hearing, since we brought it up, have you rectified their situation, and are you working with them to correct?
We're working closely with them. I expect that to be rectified very shortly. They are waiting on some information from their utility company, and then at that point we'll be able to completely close out that situation.
I appreciate that, and that is obviously a sign of good faith. And obviously we don't expect perfection. No industry has a 100% consumer satisfaction record. There's always going to be things that fall through the cracks. There's always going to be things that unfortunately go wrong, and then obviously up to that industry to determine the best way to solve that. But also it's up to that industry, and in this case, your company, to determine what are the best case scenarios in terms of how we can prevent this from happening in the future. Clearly, this is an emerging market. There's a growing consumer base here. But I think, as talking to my colleague, Ms. Brown from San Bernardino, there are a number of troubling practices within. That's not an indictment on the whole industry. It's not an indictment on PACE, nor is it an indictment on your companies. But it's a sheer fact that because of the nature of this business and the fact that it's rapidly growing, we've seen a number of issues within consumer protection that are not up to par. One of the things I've seen is how are seniors targeted? How are individual consumers targeted? You know, I've had individuals come to my door, I won't say from which companies, offering these products who are clearly not trained in the nature of what they're selling, who are clearly there for sole financial gain, trying to upsell. I've talked to a number of people, obviously, that are very qualified, that are very well-versed, and are knowledgeable to the point where they can actually advise a consumer on what would be a good decision in terms of energy efficiency upgrades, not just for environmental protection issues, but to really save money. I mean, how do you differentiate between your marketing techniques, and also, you know, how do you focus your marketing in terms of seniors especially? And then also my final question was, and this isn't trying to be loaded, but we've come to the conclusion now where we've seen that, you know, this industry believes that having the super lien is a necessary tool to be able to offer these products to the broadest base of consumers at the rates you're doing. And we're not going to rehash that right now, but it appears that you're offering second-tier status interest rates when you have a super lien priority. I mean, you're looking at the rates you're charging would be more on par if you didn't have a super lien priority. And knowing what you're going to the market to get those bonds and get those rates, to get that capital, it would appear that you are somewhat, in terms of the rates you're charging, selling these products as if they weren't first-tier priority for the super lien status.
But could I just say, Mr. Dubovny, I mean, that's the way the legislation, in essence, was set up, right? To allow counties and municipalities to be able to do this taxing entity, which by definition is...
I don't think that's in question. I'm just talking about the rates that are being charged to consumers based on risk. You have, at this point, zero risk because you have a super lien status, and that doesn't take away from the fact that there's very little in terms of actual foreclosures and actual your documentation and your evidence is clear on that. But it just seems like we're talking about the super lien as being a necessity for the product that you're offering. The rates that are being charged don't seem to match that.
I heard a couple of questions in there, and I'll come back very quickly, and I'll come back to that. And with regard to senior citizens, we have a policy that we execute on every transaction where a senior citizen or protected class over the age of 64 applies, that they receive a call back from a Y-Green certified employee, and before the application can be completed, and certainly before approved or any lien can be placed on the home. So there's that while the contractor may introduce the concept of PACE financing, there is absolutely no way that a contractor can bind a senior, frankly anybody, but in particular a protected class. We also have...
You all do that, everyone?
Yeah. We also have English as second language documentation for communities that do not speak English as a primary language. So there are other protections too. Focus on those two. With respect to contractors, while it is a very small percentage of the contractors that we certify that ultimately are determined to be bad actors and can't be remediated and have to be removed from the program. The handful that we have removed include some contractors that have generated a very large amount of business, and that's not to say every transaction is bad, but one strike, two strike, three strike, you're out type policy regardless. So we've demonstrated, we have a clear demonstration of not protecting our financial interests over the interests of the consumer.
And would you report them to the state board when you do catch them, or do you have complaints?
We will if we have a real time or a daily verification with the CSLB. I don't know that we've ever caught it before the CSLB. Consumers tend to make that, but yeah, that verification happens. So it would occur if somehow they were not on the CSLB's site for a violation. But to the interest rate, it's not only the risk or lack of risk in terms of repayment that determines the rate. There is the duration, there's the underlying collateral, but most importantly, I think in the PACE industry to keep in mind is that this is still, even 8 years in, a very young industry from a financial asset class perspective. And while it sounds very secure, and all of us believe that it's a very secure asset, and we understand here in California what our default and delinquency rates and repayment and recapture rates are, selling that asset and those characterizations for the first time into a secondary financial market requires them to make a leap of faith, as well as an enormous amount of analysis. So that is what we're still seeing effective in the market. And also when you bring a new financial product, any financial product to the secondary market, but particularly a new one, there in the early days, however long that is defined, and that's really defined by a number of factors, but particularly experience and amount of transactions brought there, that transaction cost, legal, financial, analytic, and other transaction costs are higher. So for those reasons and many others, you might see what you think or what a layperson would think is a distortion in the market in terms of the relationship between the risk and the interest rate. Finally, the interest rate that most people experience when they use a non-cash or credit-based financing, whether it's a solar lease or a credit card or anything, frankly, other than a home equity line of credit, their interest rate is far greater than anything we've seen in the PACE industry. In fact, sometimes 2 and 3 times greater. So we feel like we're being very good students of the program and on the financial and capital markets end as well.
Yeah, if I can just comment on that too, I would just say that on the interest rate question specifically, the PACE is not going to be the solution for everyone. And if someone has access to an open-ended home equity line of credit that hasn't been tapped and that is available to them if there's an unplanned expenditure and they need to tap credit, that might be the better solution for them. But this is fully amortizing fixed-rate financing. It's not variable rate financing, which is part of what you sometimes see when you have lower interest upfront costs. And it's fixed rate and fully amortizing over term, so meaning over 5, 10, 15, or 20 years. Those are long terms of financing. Additionally, you are in a dynamic where homeowners are making decisions about what kind of financing to access when they have to make an improvement on their home. And again, as I mentioned earlier, oftentimes that's an unplanned expense. So oftentimes, frankly, before PACE, those homeowners would take on an unsecured consumer loan that might have a teaser rate and then a balloon rate or a go-to rate that could be 3 times the amount, or swipe a credit card or take on other forms of financing. So PACE is not designed to be the answer for every circumstance or the answer for every borrower. Or every customer. It's designed to be an option in the marketplace that's obviously facilitated by the local government public-private partnership that is obviously defined in statute.
Thank you. All right. Thank you very much to this panel.
Thanks.
In the essence of time, we'll call up, as we thank our last panel for leaving the stage, we'll call up our next panel. George Cook, Chief Executive Officer of El Dorado Savings Bank; Tony Diaz, Vice President of Compliance at Schools First Credit Union; Craig Page, Executive Vice President and General Counsel of California Land Title Association; Stan Wiggs, Staff Vice President, California Association of Realtors; and Elizabeth M. Knight, President of PLM Lender Services, Inc. In the essence of time, because we are up against a little bit of it, we're going to ask everyone to stick to their 5 minutes, but if you don't need all 5 minutes, there are brownie points for going a little under. So, okay. Mr. Cook, we have you first today.
Good morning, chairs and committee members. I will be brief. My name is George Cook. I'm with El Dorado Savings Bank. I'm the Chief Executive Officer. I'm also currently the chair of the Government Relations Committee for the California Bankers Association, and I also serve on the California Bankers Association Executive Committee. Briefly about El Dorado Savings Bank, we're a $2 billion institution based in Placerville, California. Our 31 California offices are based in Sacramento, the foothills, and the north side up in Grass Valley. South to the south, it extends to Twain Harte. We also have offices in the Tahoe area. What we do as a bank is exclusively or virtually exclusively limited to mortgage lending and home equity line of credit lending. And unlike some of the other presenters that you heard today, we don't sell any loans to Fannie Mae or Freddie Mac. Everything that we do goes into portfolio. So I'm not anti-PACE type lending. The issue that I have is simply, in my view, it shouldn't be a super priority lien. It should go into a lien status just like the typical second loan lien. And I'll give you an example of why I think that should be that way. If we're making a loan on a $200,000 house, somebody's buying it or refinancing it, an 80% loan, we're going to make a $160,000 loan. We're going to view the borrower's credit, their income, their balance sheet. And in addition to that, an appraisal, the collateral, but in addition to that, we look very carefully at a title policy to make sure there's no other liens in front of our lien other than the typical real estate taxes. What we're facing as a community bank and all other bankers that are making loans and other financial institutions is we make that loan today and we're in a first position at 160. And 6 months from now, the PACE financing goes in there. It can be $30,000 or $40,000. I don't know all the rules of it, but it can be a significant amount, and it distorts everything that we underwrote to begin with. So my basic intention, it's flawed to have the super lien priority. The other part, and I'll close with this, I don't know how well the PACE lenders, it probably varies on how well they disclose to consumers. Probably some do very well. I can tell you at our bank, when we bring up to our customer that when we receive a title report, hey, there's PACE financing on there and it's for $35,000. We haven't heard one yet whether they're being directly with us or very honest with us. They are all stunned that it was a lien. There's a lot of confusion from consumers. Maybe they should read better, but a lot of them give the typical answer, and our loan officers would verify this. It's paid with the taxes. That's all I know. So I'll leave it at that.
Thank you.
Good afternoon, Mr. Chair, Madam Chair, and members. My name is Tony Diaz. I'm the Vice President of Compliance at Schools First Federal Credit Union. Thank you for having me here today to speak from the credit union perspective. Schools First Federal Credit Union opened in 1934 as the credit union for Orange County teachers, and today we serve over 700,000 school employees and their families in 10 counties, including Orange, Los Angeles, Riverside, San Bernardino, and San Diego. Currently, we have 18,638 first mortgages, totaling approximately $4.3 billion, including loans that we have sold to the GSEs, but in which we have retained servicing rights. Our credit union is very concerned about property assessed clean energy loans for a number of reasons, but the main one is that our members are in many cases being negatively impacted, and we are often the one who is delivering the bad news when they come to us to apply for a loan. An average of 6 members per week apply for mortgage loans with our credit union on properties that are encumbered with a PACE loan. We advise these members that due to the priority lien status of the PACE loan, they will have to pay off this loan prior to us being able to refinance their existing mortgage loan. The vast majority of members are confused by this. They do not understand the lien aspect of it, and they tell us that they were not informed at the time that they applied for the PACE loan of the obstacles that they would encounter down the road when attempting to refinance their mortgage. Depending on the amount of the PACE loan, the member is able to pay it off as part of the refinance. However, there are other instances when the PACE loan is for $30,000 or $40,000, and the loan to value of the loan is already at the top of what we will finance due to the equity on the property. If it is these members who suffer the most, they're unable to get a loan. We must decline their loan due to the impact that paying off the PACE loan has on their LTV. This results in some very difficult conversations for us because in the majority of these cases, the member had no idea that this loan would not subordinate and would have to be paid off prior to refinancing their existing mortgage. The worst cases are those where we could save the member a significant amount of money on their monthly payment by refinancing, but we cannot help them due to the issues with the PACE lien. These are problems that will only be fixed by reforming the current PACE program. Credit unions around this state support green energy and support water efficiency and believe that the PACE program does serve a valid purpose. That being said, we believe that there are 3 important reforms that are absolutely necessary to make sure that PACE does not harm the housing market in California and, most importantly, does not harm homeowners. The first is disclosure. As a regulated lender, our credit union provides important consumer protection disclosures and policy agreements that are regulated by the Consumer Financial Protection Bureau, the National Credit Union Administration, and the state of California. Clearly written, comprehensive disclosures provide consumers with the information they need to make informed decisions. Currently, there are no uniform disclosures that the state requires of PACE lenders. Of course, even with the disclosure, there are other important protections that any homeowner who is taking out a substantial loan that puts a lien on their property should be provided. Therefore, the second protection, underwriting. Underwriting is an important consumer protection that makes sure a consumer can afford the loan that they're considering. The CFPB's ability to repay qualified mortgage rule requires lenders to make reasonable good faith determination that a consumer has the ability to repay a covered mortgage loan before or when the lender consummates the loan. Our credit union has implemented robust practices that consider all of the ability to repay requirements mandated by the CFPB. We're diligent about originating loans that meet the qualified mortgage definition when necessary, whenever possible, since these are the underwriting criteria that have been deemed the most appropriate by our regulator. When a loan does not meet the QM definition, we obtain pay stubs, we obtain tax returns, we obtain bank statements, multiple items to ensure that the member has the ability to repay the credit that's being extended. We obtain a credit report. We order and review appraisals to ensure that the property value supports the loan being requested. We have the member sign over 20 disclosures. Above all, we are transparent to the loan applicant about the nature of the loan transaction. And as you know, currently there are no underwriting standards required of PACE lenders that include a credit score, ability to repay, or loan-to-value ratios. Most important of all, and the consumer protection issue that needs to be addressed as soon as possible in our eyes, is the super priority lien attached to the homeowner's property. A lien jumping ahead of a first mortgage puts credit unions at risk, and any risk to the credit union is a risk to our members because we are member-owned, not-for-profit financial cooperatives. Additionally, as we heard from Mr. Pollard, since the FHFA has directed the GSEs not to purchase loans with a PACE lien attached, our only option is to keep these loans on our books. As I previously mentioned, in many cases we are unable to do so because the loan-to-value exceeds the ratios that our Board of Directors has deemed to constitute safe and sound lending practices. These loans are being sold as transferable with the property, but in reality, homeowners in many cases are facing balloon payments and are being forced to use any small amount of equity they have left in their homes or cash to pay off the entirety of the PACE loan, or they are stuck. Finally, during the foreclosure crisis, California's credit unions helped keep our members in their homes by doing loan modifications and finding creative ways to work with our borrowers. I fear that in the next market downturn, we may have limited options to help homeowners who have had PACE super liens attached to their properties. Thank you for having me today, and I'd be happy to answer any questions.
Mr. Page.